Hello everyone and welcome to Intergalactic Markets. Today we will be going over the basics of foreign exchange markets, also known as Forex, FX, and currency trading. We'll talk about the market itself, currency pairs, pips, lots, and bid-ask spread. I'll link each topic to a time in my video in the description below, so check that out if you want a quick information. So what is Forex? Well, in essence, the foreign exchange market lets you trade the currency of one country for the currency of another 24 hours per day, 5 days per week. As such, the average foreign exchange trading volumes were $6.6 trillion per day in 2019, making it the largest investment market in the world by far. By contrast, the New York Stock Exchange only boasts an average trading volume of around $25 billion per day, according to Investopedia, though this number is much more volatile. While Forex volumes are mostly fulfilled by banks, millions of tourists actually engage in foreign exchange daily when they convert their home currency to the local currency of the country they're visiting. The most traded currencies in the foreign exchange market are known as the majors. They make up 85% of the total trades in this market, and they include the US dollar, the euro, the Japanese yen, and the Great Britain pound. So the value of a country's currency depends on a variety of factors, including supply and demand of the currency, local interest rates, geopolitical developments, and much more. So for example, if the US Federal Reserve decides to conduct quantitative easing or increase the supply of US dollars, the dollar will weaken or lose value due to inflation. So how exactly does this work? So in Forex, trading is done using currency pairs, which shows the value of one currency to another. For example, here we have the exchange rate between the US dollar and the Polish zloty. This is called the Forex pair. The US dollar is our base currency, and the Polish zloty is our quote currency. For each Forex pair, there is a market price associated with it that refers to how much of the second quote currency it takes to buy the first base currency. In this case, it takes 4.0125 Polish zloty to purchase 1 US dollar. On average, these exchange rates tend to fluctuate between 0.5 to 1% daily, so not too much. So we established how many Polish zloty it takes to buy 1 US dollar, but how many US dollars does it take to buy 1 Polish zloty? So it's very easy actually, since it's just basic fraction rules that apply here. We're given the zloty denominated currency pair, and we have to flip it. So to do this, we divide 1 by this given value. And we have found that the value of the PLN to USD currency pair, showing us that it takes 0.2492 US dollars to buy 1 Polish zloty. Here's the currency pair in the standard notation. So now let's talk about pips, or percentages in point. So it's important to understand Forex lingo to be able to navigate brokerages and trade effectively. So currency pairs are almost always noted to the 4th decimal place, as you can see in this US dollar to Polish zloty currency pair here. A pip, which is an acronym for percentage in point, is the standard and smallest possible unit of measurement used by FX traders for a change in price of a currency pair. It is equivalent to 0.0001 quote currency units, or in our case, the Polish zloty. For example, if the US dollar to Polish zloty exchange rate went from 4.0125 to 4.0124, it means that the Polish zloty appreciated in value relative to the dollar by 1 pip because it takes fewer zloty to buy the same 1 US dollar than it did before. Now let's go over pips versus bips. It's really important not to get these two confused, even though the concept is pretty similar. So another common unit of measurement in finance is the basis point, or BIP, which equals 1/100th of a percent. Thus, while pips measure a change in price or value, BIPs measure a change in returns or rates as percentages. So from our last example, we know that our zloty appreciated by 1 pip relative to the dollar. But how do we express this using BIPs? Well, just use the formula to get the percentage change, which is the difference in values over the original. Once you get the percentage change, multiply by 100 to get your value in bips, which for us would result in an appreciation of the Polish zloty by 0.25 bips. Like I mentioned earlier, the exchange rates for different currency pairs will fluctuate by 0.5% to 1% daily on average, and it is often difficult to predict exactly how they will fluctuate. In addition, one unit of currency, think of $1, is typically a lot smaller than your average security. One share of Amazon stock, for example, is almost $2,000 as of the time of this video. Thus, currency is often traded in different sized lots, ranging from nano lots to standard lots, which themselves range from 100 currency units to 100,000 currency units respectively. FX traders will often put down a deposit called a margin with their brokers, so they can increase their positions to capture larger nominal gains using leverage. For example, some brokers only require you to give them $1 as a margin deposit, and then they will give you $100 to trade currency with. Lastly, we'll be talking about bid-ask prices, which for me was one of the more difficult things to wrap my head around. The bid-ask concept in Forex is much like the bid-ask concept for securities, but in Forex you must think of your base currency, for us it's going to be the US dollar, as the security here being bought and sold for your quote currency, or the Polish zloty in our case. So here you can see that the notation for our US dollar to PLN currency pair looks a little bit different. On the foreign exchange, currency pairs are denominated like so, with a slash separating the bid or sell price on the left from the last two digits of the ask or buy price. So let's say you enter the Forex market with $1 US. Using the bid price, we can see that with the dollar, you can get 4.0125 Polish zloty. That is what we sell our base currency, the $1, for. Really, we're paying for 4.0129 Polish zloty, but we only get 4.0125 in our account because 4 pips go to the broker as a fee. Now, using the ask price, we see that the exchange rate for $1 US is 4.0129 Polish zloty. Because we only have 4.0125 Polish zloty in our account, we can only get 0.9999 US dollars back. So here's a more detailed step-by-step of the math we just did to exchange a US dollar for a Polish zloty and then re-exchange back to the US dollar. So first, starting with a dollar, multiply by the bid price to see how many Polish zloty you end up with in your account. Next, use the ask price to convert whatever amount of Polish zloty you have in your account to US dollars. To do this, divide your current account value of 4.0125 PLN by the ask price of 4.0129 PLN. You end up with less than $1, representing the impact of broker fees. Again, you're essentially always using the ask exchange rate, but that includes a premium for the broker, which you do not get to keep in your account after the first trade. That premium value is 4 pips. So as we discussed, the ask price will always be a few pips higher than the bid price due to the broker fees. The bid-ask spread is used to calculate these broker fees by subtracting the lower bid price from the higher ask price. The higher the spread, the less liquid the currency is. Thus, for more popular currencies, such as majors like the US dollar and the euro, you'll see a lower bid-ask spread because the brokers earn their fees through the high trading volume of these pairs. In the example we discussed previously, the bid-ask spread is 4 pips for the US dollar to Polish zloty currency pair. We got this by doing the ask price of 4.0129 minus the bid price of 4.0125, resulting in 4 pips. So that covers it for Forex basics. Now you know enough to navigate the foreign exchange market effectively. If you want to learn more about Forex, be sure to check out my videos on triangular arbitrage and currency forward contracts as a means of hedging. If you enjoyed, please like and subscribe for more content. Cheers and happy trading.